Hello everyone, my name is Denise Lynn and thank you for joining me for our webinar today. Today's topic is all about how to automate investing, as learning to invest can be a challenging process. But once you've developed a plan, there are several steps one can take to assist with reaching your long-term goals. So joining me shortly will be Bryan Rogers, a client education instructor with TD Direct Investing, to discuss a few passive investing tactics that can be used to build and incorporate into your portfolio with minimal time and effort. Without further ado, please join me to virtually welcome Bryan. Hi, Bryan. Thank you so much for accepting our invite. We're all excited to have you here. How are you today?
Oh, I'm doing fantastic, Denise. Glad to be here.
That's great to hear. Now, for those of us who have yet to meet Bryan, he is a senior client education instructor who hosts many sessions surrounding a variety of investing topics. So that could be from stocks to investing strategies to options, you name it. All right, Bryan, are you ready?
Yes, let's go.
Good to hear. Now, we've both been exposed to the financial world and investing for quite a while now. The world, society, and technology has definitely immensely evolved, which means we have more and more of that investing news information just right at our fingertips, which can get really overwhelming for someone when we're just starting to invest. Why do you think that is?
Well, Denise, I think after settling on a plan, you've
Mhm.
calculated an investment amount and you have a time frame and all those kind of basic things that you do when you're setting up your goals. Individuals often struggle with that next step. So they know they need X amount of dollars per week or month or that next time frame, but they don't know how to implement this. A lot of common questions we hear are, what do I invest in? Or do I need to save a large lump sum? For example, do I buy small amounts every time I save? Or how do I transfer the money? What if I forget to save? I know that's one I suffered from a long time. Is you forget about this, and then it just becomes something that's a non-priority, right? So do I have to buy the investments on my own? Is another question each
Mhm.
week, each month. What are the fees? Can I buy partial investments? Is a common question. How can I make sure all of my cash is working for me? Is what people are really concerned with. But with all those questions, as you can imagine, like, it becomes a little bit overwhelming, and some people get either a little bit too confused or too scared to even get started.
Yeah, definitely. Those are some of the questions that I've come across too. There's lots of questions, but they are important questions nonetheless to really get a thorough understanding to get started. But I'm sure nobody likes tackling all of those questions since we want to make things a little bit easier. So, how could someone who's new to investing make this part of the process a little bit easier? That way they can feel more confident and easier to start right away.
Well, yeah, we need to take advantage of some of the technologies that are out there. I know a lot of us have new technologies like things you can turn your lights on
Oh,
when you're
yeah.
not even at home, like from your phone. We have self-driving cars and things like that. But there's been tools that have been around for quite some time in the investment world where you can automate your investing. So it's kind of like putting things on autopilot, right? Like that self-driving car, which I think everybody wants to get. So that is what you can do is to take that and go to somewhere like TD Direct Investing, your brokerage firm, and ask them, is there a way that we can combine the idea of that automated investing so that, pre-authorized deposit, which a lot of us have our paychecks automatically go into our bank account. We have automated bills. So you can do that where you have an automatic amount go into your TD Direct Investing account, and then you can have it set up where it'll automatically purchase an investment that you choose. So in that case, by establishing a pre-authorized payment and combining it with what we call a systematic investing plan. So you hear a PAD and there's a SIP and there's a monthly contribution plan like MCP. We love our acronyms, right, Denise, in the banking world.
Definitely.
So once you get that set up, it's kind of like that self-driving car that putting things on autopilot, and then you can fix it and forget it for your investing.
Okay, that sounds amazing, especially for self-direct investors. We're all trying to tackle on so many different roles, just multitasking, being our own portfolio manager, advisor, and investor as well, right? So anything to really simplify our life or investing would be great. And we'd love to put more of that life on that autopilot that you mentioned. So, how can we actually set this up as a self-directed investor, Brian?
Well, this whole process is made possible with the use of mutual funds. It's
Okay.
something you can still do that pre-authorized deposit into your account, and that might take care of that issue in terms of making sure you're putting the money aside. Now you can actually put money into one of these funds with no transaction cost. So once you've identified that, the next step is to contact Direct Investing and ask them to establish that pre-authorized deposit. So that's going to get the money into the account for a certain amount. Like let's say if we say $250 biweekly, for example, if you get paid biweekly on a Thursday, you can have that money automatically go in, and then you call TD Direct Investing and say, now I want to establish a systematic investment plan, is sort of what they call it for a taxable account or a monthly contribution plan,
Those
where that's going to
acronyms
control.
again.
Yeah, those acronyms again, for sure. And then but really all it comes down to is that you're going to automatically invest into that fund on the same day that the money comes into the account. So, those are some steps that you won't have to take every single time.
Hmm.
And, if you continue on a biweekly basis or monthly or daily, it's going to continue onward until you instruct otherwise.
Okay, so that way, rain or shine, it's still happening in the back end without us having to do much.
Yes, yes.
Okay, great. Because mutual funds was also the type of security I was exposed to at the beginning of my investing as well. And pairing with that SIP that you mentioned, systematic investment plan, really helped me stay consistent and constant without too much effort. So this sounds quite easy. And just to be transparent with us all here, just to get the full understanding, let's talk about some of the advantages to this approach.
So one advantage is the simplicity. So the fact that you can set it up and you don't have to worry about it again. So this is typically for those newer investors that are just getting started and you may not have as much knowledge. But even some investors that have the knowledge do it because they don't want to take the time, right? So its convenience aspect is kind of goes along with that simplicity. So there's no need for the manual transfers. There's no chance that you're going to forget. You're consistently paying yourself first. That's a common term we've all heard,
Yeah,
right?
we always hear that. Pay yourself first.
Yeah, absolutely. And then additionally, for most funds, for most mutual funds, there's no commission fee. So as I was saying, that 9.99 that you normally pay to buy a stock,
Hmm.
that would eat away a small amount. If you're going to put in that $200 or $250, that $10 is going to eat away at a lot of your returns, where there's no transaction cost on most mutual funds. So it's very minimal compared to buying small amounts of the stock every time. That kind of plays in with that idea of affordability, but also when I say affordability, what I mean is you oftentimes would have to save up quite a bit of money to buy 100 shares of stock or whatever number of shares you feel is going to be worthwhile in terms of buying equities, where you can buy oftentimes usually as low as $50 a week or a month or biweekly or whatever it may be with the mutual fund, the systematic plan. So that's where it's the affordability. If you don't have a lot to start out with, then this is a great tool to use.
Okay, so we just kind of bust that myth where you have to have a lot to start investing. This can really assist with that if we don't have that big of an amount.
Yes.
Okay, good to know.
So another thing too is mutual funds have a built-in diversification. So this is still on the advantages side.
Uh-huh.
It kind of can be a disadvantage, which we'll talk about in a second. But because I know you're going to ask, what are the downsides? But they're professionally managed. So, that's something that if you're not knowledgeable and you have no clue what you're doing, you're letting somebody else do it for you within that mutual fund. So it's going to eliminate that extra time spent or that knowledge required. And then another one that a lot of people may not be aware of until they venture into this is with some accounts at TD Direct Investing and other brokerages, there may be a fee potentially where if you're not contributing enough to your accounts or doing enough trading and things like that, there could be a maintenance fee every quarter. With TD, usually it's about $25. One of the really easy ways to eliminate that immediately is by doing a systematic or a pre-authorized deposit and a systematic investment plan of $100 or more per month. That eliminates you ever running into that fee.
Okay, so that allows us to kind of kill two birds with one stone.
Yes, yes. And then one really key one I wanted to reiterate is the fact that you're going to get dollar cost averaging. So that's another potential advantage where because you're buying that fund in intervals, the
Hmm.
fund's going to be going up and down over time. So you're buying it at different intervals at different prices. So that's another big plus.
Okay, great. Well, this follows our theme perfectly for that long term investing approach where we can continue utilizing all these different strategies with that minimal time and effort needed from us investors. Like you mentioned, there are always two sides to things. So we are actually going to get into some of the possible disadvantages. Could you highlight some to us?
Yes, a lot of people hear about in the, different things on commercials and
Uh-huh.
other, reading about investing, about fees that mutual funds charge. So, that could be a disadvantage on, you want to look for funds that don't have a large, what they call management expense fee. And I want to be clear too, I'm not saying a fee as a commission. We mentioned that there oftentimes are no fees from a transaction fee perspective. But most mutual funds do charge an annual fee of, could be anywhere from 1% to 3%. And that could eat away at your returns if you're doing this way. But once again, I did say there's that advantage of dollar cost averaging. This could be something, you want to watch out for, but it could be something that would be a detriment on paying those fees.
Okay, fair enough.
Yeah. And then market risk does exist too. Like, so if you're doing a high equity-based mutual fund, you're going to have some risk. You're going to have ups and downs in that position. So that's something you want to make sure you're okay with those risks. So that's sort of a suitability is what we call it. You want to be comfortable with that. Taxation could occur as well because if it's in a non-registered account, you could have tax implications such as dividends that the mutual fund pays and some of the buys and sells that the fund manager may do may incur taxable events, and you could pay small amounts of taxes throughout the year as well.
Okay.
Uh, that kind of goes along with that idea of limited control. So you're not having as much control when you're letting the fund manager run this, but that's sort of the idea. I know that could be a disadvantage for some or thought of that way as a con for some people. But if you're not knowledgeable and you don't want to spend the time and you don't have the ability, then that's the manager's going to have that all that control.
Something that did really stand out to me when we are talking about those advantages was dollar cost averaging, which is a small but mighty strategy. So, for those of us who might be new to this, Brian, it could still be a little bit complicated. Could you elaborate on what dollar cost averaging is?
Dollar cost averaging, it's kind of the idea that you're buying the same dollar value of that fund. So let's take this mutual fund we're talking about. You're doing it on a regular basis, but you're going to buy it at different prices. So that's where the advantage comes in. And sometimes, the price might be a little bit higher in some cases, but you're just buying that small amount where it's going to work out next time, where when it's dropping down, you're going to buy more units at a lower price. So, over time, it usually averages out. That's why they use that word dollar cost averaging.
Okay.
And yeah, it has that, common potential benefit of a better return than just investing, a large lump sum at the very beginning at a certain point in time. I've got an example that I'd like to show in terms of just starting out. If you can see on the screen that we're displaying now,
Okay.
you can see Fund a Fund B, and a Fund C. And the Fund A on the screen, if it was on there by itself, is showing, ideally what we'd always love to see, right? You can
Oh, yeah.
see $2,400 is what you started with, and this is just showing a lump sum. I use that number 2,400 just because we could easily equate this into, say, $200 a month over a year would work out to about $2,400. But if we were to deposit this at the very beginning, that'd be ideal. We'd love to see it where it went from 2,400. If you see down at the bottom,
It just goes
up,
straight up.
yeah, it goes up to 4,800. It doubles, right? And then, the next one, fund number B or fund letter B, we can see it goes up a little bit and it comes down and goes up. So that's something that's probably more realistic, right? Like,
Hmm.
more realistic from a timing perspective and what we see in the market. And then I know you and I have talked about this before, Denise. Maybe our luck is, we're picking the one that's at the very beginning $10, and then at the end of the year it's at ten
I know.
dollars.
That's
And
where
it's yeah, it's just went down from this point that we bought it, right? So if somebody else can relate to that, if you're like, oh yeah, I'm an investor and I can relate to that, that'd be my luck as well. Let's take a look at this and what you could do from a dollar cost averaging perspective with that same fund, like Fund C.
fun see. Okay.
Yeah. So you can see on the next slide as well, we've got a few columns here. We're looking at the month time frame. We've got the amount invested. So to make it really simple, we did $200 a month. And what do you notice, Denise, on that third column where it says the price per share? What's happening on the price there?
Yeah, so as the year went by, the fund's price just kept fluctuating. So it started off with $10 and it went to decrease and then it slowly went back up. So it's been changing the entire year.
Yeah, and this might be an extreme example for learning purposes because it's probably not going to do just that. It could
Hmm.
go just down over each month and then come back up like a perfect V in a way. It's probably going to be up and down a little bit, like moving slightly up, slightly down. But this is just to demonstrate that power of dollar cost averaging, where you see in the fourth column that we're now buying units. For example, a $200 is going to buy us 20 units in the first month. Then when the price goes down, it buys us 22.2.
Hmm.
What do you see, Denise? Like once we get down to about the seventh month, are we
Okay.
buying?
Yeah, you know what? The fund price dropped down to $4, but in return, we're actually able to buy 50 units.
Yeah, so you can see that's a big benefit. Now, if we're holding on to this and as it comes back up, we just got a lot more units that are going to eventually have value, right?
Yeah.
So that's where you can see that happening. And in the end, you can see in the next few columns, you see the total units bought kind of fluctuates. The total value, if you see the amount invested, that still stays the same. We're only
Okay.
investing $2,400. But what do you notice about our total in the very end, even when this fund closed at the exact same price as when we started?
At the very end, at the 12 month, even though you said we invested 2,400, there is a total balance now of 3,482.54.
Yes. So you're thinking like it's $1,082 more on a fund if we had to just put that lump sum in at the very beginning and left it and not gone back to it. We would have been $2,400 if we did that lump sum. But with dollar cost averaging, you can see that big advantage of that extra gain.
Wow, this actually brought back the feeling where the whole year has gone by and you wear your winter jacket for the very first time because you've left it for 12 months and then you go in your pockets and you find extra cash.
Oh yeah, I know. I love that feeling.
Perfect. Well, thank you so much. I love this idea of automating your investing with mutual funds paired with that direct deposit and that SIP, that systematic investment plan. But we are all self-directed investors, and many of us may be interested in other securities that we offer at TD Direct Investing as well, right? So, Brian, are there any other ways of automation available?
Yes, yes. I know we heard some more acronyms already. I'm going to throw another one at you. It's called a DRIP or Dividend Reinvestment Plan. So DRIP is the DRIP acronym that we've gotten for this. And that's related to if you're an investor that's already purchased a stock, or you've inherited some equities or stocks from someone, or you have an employee plan that pays you stocks in the company you work for. A lot of those stocks are going to pay dividends, and if you want to reinvest those dividends, you can build your portfolio by automatically reinvesting those. And there's a plan, that dividend reinvestment plan, that allows you to do it without having to pay those commissions of
Okay.
putting that money back into the stock and reinvesting it over and over again.
Okay. Wow, that sounds great. I do want to get into this a bit more, but just let's bring us back to the basics. Just to make sure we all are on the same level. Can you explain a bit more on what a dividend is?
Yeah, dividends. Yeah, that's a good point. We should actually, for those that may not be aware of this, you've probably heard the term, but
Hmm.
for those that really, really want to understand this, is a dividend is something that's paid by the company where, they're going to accumulate cash, right? It's when you really drill it down, it's not super complicated where the company's trying to make as much money as possible.
Hmm.
And when they start to accumulate a lot of cash, they can either put it back into the company for future growth, which almost all companies will do so to some extent. But ones that don't need all of the money put back into itself for growth are going to pay that back to shareholders in the form of a cash dividend, and for the most part. Uh, there are other ways, but normally it's going to be coming in as cash in your account. And for every share that you own, let's say, for example, if the annual dividend the company wanted to pay was $2, they would usually pay you every quarter. They pay about 50 cents. So, $2 divided by four, they're going to pay 50 cents for every share you own. So if you own 100 shares of that stock, you're going to get $50 every quarter deposited as cash. So that's a dividend. And then that $50 will sit around. Let's say if you had more shares than 100 shares in my example, if you had 1,000 shares, that could really accumulate. Now you have $500 worth of cash. If you're not taking that money out of your account, you want it to grow for you, you want it to build your investments, you can take
Hmm.
that money and reinvest it into the stock with no cost. And that's what that dividend reinvestment plan is.
How big of a difference can this make on a portfolio's return over that long term? Can you show us a bit of an example here, Brian? Do you have anything for us?
Yeah, yeah, I've got a great example, and I'm going to use TD stock. So you can see on the screen here, that we have an example with a number of columns again where we've got a date range. And this is showing Denise about a basically 4-year time period or 16 quarters. So what do you notice when we look at, if I look at that very far
Hmm.
column or the second one from the far right in the dividend column, what do you notice about the first dividend amount and what happens after that first dividend?
Okay, so it started off with 60 cents back in 2018. And then, as I guess every quarter went by, at some points it does actually happen to increase.
Yeah, so there's another benefit you have too. So we kind of caught this example at the very end of TD's, last quarterly dividend was 60
Hmm.
cents in 2018, and then we're going from there. It goes to 67 and 74. But if you really focus on that far column, that's the dollar amount that would go into your account based on this example. So if we had 400 shares multiplied by that 60 cents, that's why we're getting that $240. So that would come into your account as cash.
Okay.
Okay. So if you see on those other columns, what we did is if we equated this to the dividend reinvestment plan, we're going to buy in that first month, we're going to buy 3 additional shares because $240 was enough at the time. That other column beside it is the price of TD at that time, $74.82. It was
Okay.
enough to buy 3 whole shares.
So what happens to the money that's left over because it doesn't equate to perfectly 240?
Oh, that's an excellent question. Yeah, that will still go into the account as cash. So you get any residual, they call it residual cash from the dividend after you're able to buy whole shares.
All right, so it doesn't go
Yeah.
missing.
No, no. And that's another key point too, Denise, is you do for this program to work effectively. And you can build up your shares over time, like you can do it manually if you have to. But if we didn't have enough shares or enough of a dividend anyway, if we didn't have that $240 or if we only had, say, $60 worth at the time with 100 shares, we wouldn't be able to buy a whole share. So it
Hmm.
unfortunately doesn't do a fractional. You would have to have enough money to buy 1 full share of TD.
Okay.
Yep. So, as we continue along, you can see that in the second month now we have 403 shares. So now we have more shares to get additional amount of dividend because remember it's multiplied by the number of shares we own, and it's going to go 406 in the next month and 409 and so on. Where you finally get down to the bottom and you're going to notice how many shares do we have in the end for basically doing nothing?
At the very end, we actually have a total of 459.
Yeah, which is not bad, right? For not having to do anything, just kind of sitting on the couch like the couch
Yeah,
potato,
without
as we
lifting a
said.
finger.
Yeah, you got an extra 59 shares, which is really strong. And at the same time, when I mentioned earlier the dollar cost averaging, this applies in here too. You can notice, like, let's say if we look in the middle around the 2020 time frame, what did the
Okay.
price drop to at that point, Denise?
The lowest I see, wow, 58 and 16 cents.
Yeah, and if you go and look at how many shares were purchased at that time, we ended up purchasing 5 additional shares in those months when that stock dropped. So, TD, you're still owning those shares. They're going to, go up and down over time, but as they're coming back up, which they are now, we now have 459 shares that we bought over the last 3 years
Oh, that's
without contributing
interesting.
anything else. Yeah,
I know. And you know what? The dividend amount also fluctuated and increased during that time frame too. So that's an extra bonus for us investors.
absolutely.
Thank you so much for painting such a great picture for us, as a picture is worth 1,000 words. But you know me, I would love to take a look at the positive and negatives on everything with this as well. So, would you like to go over some of the pros and cons for this DRIP program, this dividend reinvestment plan? I think we've drilled DRIP into everyone's head by now.
Now everybody's going to love all our acronyms. You learned several new ones today. For sure. So the dividend reinvestment, some of the pros I would say is the fact that the most obvious one is that there's no commission fee. So if I wanted to buy every time that quarterly dividend comes out, wanted to buy the stock, I'd have to pay 9.99 to do so, right? And if I'm only buying 3 shares, that really eats away at my profit at that point. So that's a huge advantage, a huge pro to dividend reinvestment. Another one is the one we mentioned, like that dollar cost averaging. That's going to happen in those events that the stock does drop, and over time it's going to be up and down. But when the times that it's down, you're going to buy those additional shares
It kind of averages out, right?
for sure, for sure. And then one that's they always say, and I think it's the sixth wonder of the world, compounding that concept is it's going to be compounding too. Right now we have 459 shares. Imagine if you were even still, doing your RSP contribution every year of another
Mhm.
5,000 or whatever amount you're putting in, you can actually buy more shares, and that's going to even compound that even further. And that drip is going to continue to add leverage.
So that's that snowball effect that you might hear a lot of people talk about.
Yes, absolutely. On the negative sides, on the cons, is there is no control, similar to when we were talking about the actual systematic investment plan. You're not really controlling it because you're buying these units at a prescribed time. Like it's going to happen pretty much right away, within a day or two of that dividend coming into your account. You're going to see that reinvestment happen. So some would argue like, well, why don't I just let this build up in my account, and why didn't I buy a whole bunch of shares when it dropped down to 50 in the 2020s? You could do that. Realistically, you could do that, but how many of us have that discipline and timing and the knowledge and know-how and even the time in the day, right? If you're not, you're doing your regular job, you may not have that ability, and you could easily miss that window.
Yeah, for sure. That's relatable.
For sure, for sure. And then there is the potentially reduced diversification. So be careful on that. You don't want to all of a sudden, I know I've had that before, have the tendency to, well, why don't I put all my money into this one stock and I'm going to get as many dividends as possible? Now you're running into that risk. Is the stock going to drop severely? Because you don't want that market risk in there. You want to still have a somewhat of a diversified portfolio.
Okay.
But on the ones that you have, you can definitely apply it for sure. And I'd say the last one, just give you one more, I guess, potential con is you wouldn't get any income, right? So if you're in this for getting income out of your account, whether it's in a taxable account or even in your TFSA or RSP, if you're trying to generate income that you're going to pull out every year or something like that, you'd have to sell some of your positions to do so, or because you wouldn't have that income. But you can set up, different stocks to where they're not in the program, and you can generate income. But that could be a potential downside.
I see. There's still flexibility within this program to really match up to different investors' needs.
Yes, yes.
Okay. Well, all right. If we're interested in terms of setting this up, how we go about implementing this into our accounts?
Yeah, well, for when we talked earlier about the systematic investment plan, both of these are very similar in the fact that you do have to call.
Okay.
There is a form, and we've got a link on there that we've got everybody can access to add on the pre-authorized deposit. This is if you're just looking to put money into your account. So the other one, the systematic investment plan, would be something you have to call for, and that's actually the same. That applies for the dividend reinvestment plan as well. So if you have stocks in your account already, you can apply it to individual stocks if you only wanted, say, TD to have dividend reinvestment and another stock to not have it. So you have that little bit of flexibility you mentioned, like that income. Yeah, you can do it that way. Or if you really want to make it extremely easy, you can set up the entire account, enroll the entire account, whether it's all of your accounts, whether it's your RSP, TFSA, whatever ones you have those dividend paying stocks in. You can enroll the entire account, and then anything you buy or anything you sell, et cetera, like once you sell it, it's not going to matter. But once you buy something else, it's going to automatically be enrolled into that dividend reinvestment.
Oh, okay. So then you can really fix it and forget it.
Yes, yes.
All right. Okay, that sounds good. Well, there you have it, everyone. This does conclude our first portion with Bryan here. We are about to actually transition into that Q&A session shortly. So if you have yet to submit your questions, it's not too late. We're both really excited to see what you're all thinking about. All right, Bryan, are you ready to get started with some of those questions that we may have from the audience?
Oh, yes, I'm excited.